Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. Today, we are going to talk about CYIENT DLM, a stock which many of us are not aware of. It is a niche electronic manufacturing service provider specializing in aerospace, defense, medical sectors, presenting an intriguing investment paradox. Now, despite delivering explosive 68% CAGR profit growth over 5 years and a robust 36.5% year on year net income jump in quarter 4 of financial year 2025, this 3,800 crore small cap stock trades 45% below its 52-week high. It remains underwater versus its 2023 IPO, which was listed at 401 rupees. With 65% bullish analyst ratings, 62% upside potential, but zero dividend history and mounting working capital challenges, this under the radar stock demands closer scrutiny from growth oriented investors. Cyient DLM is a leading electronic system design and manufacturing player that provides integrated solutions across entire product life cycles from concept through manufacturing and certification. The company specializes in system design, integration, testing, manufacturing of electronic components, subsystems for original equipment manufacturers. The company focuses on low volume but high mix LVHM products with an emphasis on quality and customization according to the customer requirements. It typically enters into 3 to 5 years master service agreements with customers, providing some revenue stability. This niche positioning can be advantageous as it typically involves higher margins compared to high volume, low mix manufacturing. Cyient DLM serves several high value industries, including aerospace and defense, medical technology, industrial automation, energy sectors, to name a few. The company has established a global presence with customers in India, Europe, North America, China, and Japan. The quarter 4 performance of the company has been impressive. For the period ended March 31st, the sales increased to 4,280 million versus 3,618 million a year ago, which was a 18% jump. Net profit climbed to 310 million versus 227 million a year ago, a 36% rise. If we check the full year's performance, sales for the fiscal year 2025 grew to 15,196 million rupees versus 11,918 million a year ago, which is a 27% jump year on year basis. Net profit rose to 236 million versus 209 million a year ago. The quarter 3 results also showed a strong growth, but there was pressure on profitability. Revenue grew by 38%. Profit after tax was down 41.7%. EBITDA fell by 5.3%. Now, employee cost and other expenses were higher due to consolidation with Altek Electronics, which Cyient Limited acquired in October 2024. Looking at the long term financial trends, the 5 year compounded sales growth was at 24%. 5 year compounded profit growth was at a good 68%. 3 year compounded sales growth 23% versus 3 years profit growth, compounded profit growth was at 25%. However, recent stock performance has been poor with a 1 year return of approximately negative 28%. Now, checking the valuation matrix and market position. Now, as of April 2025, the current share price was hovering around 480 rupees. Market cap is around 3,800 crore rupees. The 52-week range of the stock price is between 350 to 873 crores. Stock PE is 49.8, which is slightly higher than the industry standard. Book value is rupees 120. Price to book value ratio 3.99. Now, dividend yield, there has been no dividend that is paid ever since the IPO was listed in 2023. Return on equity is moderate at 12.3%. Return on that was return on capital employed, I'm sorry, and return on equity is relatively low at 8.23%. Now the company went public in July 2023. IPO price band was around from 250 to 265 rupees per share. Now it was listed at 401 on BSE and 403 on NSE, which was roughly 51 to 52% premium. IPO was heavily oversubscribed by 67 times the equity offered. Now, currently trading at around 480 levels, which is above the IPO price but below its listing price. This stock has received a generally positive rating from analysts. Approximately 65% of the analysts recommend a buy on this stock. Average target price ranges between 580 to 780 rupees per share. This suggests a potential 20 to 60% upside from the current levels. According to six analysts, the average target is 580 rupees per share, 23% upside from its current trading levels. Now, balance sheet analysis, if we check, the total assets of the company stand at 1521 crore rupees. Equity capital is of 79 crores. Reserves are growing steadily and are currently at 876 crore rupees. Its total debt is 196 crores, decreased from 337 crores in March 2022. Working capital days are 135 days in financial year 2025, increased from 97 in financial year 2024, indicating a potential pressure. Cash conversion cycle is 175 days in financial year 2025, increased from 126 days in financial year 2024. Now, this suggests slower conversion of sales to cash. Also, a potential downside when it comes to the operations of the company. Debtor days stand at 81%, increased from 69% in 2024. Inventory days 175, slightly reduced from 184 in 2024. Now, the trend in working capital matrix shows some deterioration, which could impact cash flows if not addressed on time. Some recent business developments that we should take note of. Well, the company acquired Altek Electronics in October 2024, expanding its geographical footprints and capabilities. Signed a memorandum of understanding with Arcado Systems in December 2024 to establish 500 kWp solar power plant at its Mysore facility. It has expanded strategic partnership with Deutsche Aircraft on April 10th, 2025 to collaborate on an advanced cabin management system. However, order backlog at the end of December 2024 declined by 152 crores to 2143 crore rupees on a year-on-year basis. To summarize the strengths and weaknesses, firstly we look at the strengths. It has a strong growth trajectory. The company has demonstrated impressive long-term growth with a 5-year CAGR sales growth of 24% and profit CAGR of nearly 68%. It is a niche market that it caters to. Now, focus on low volume, high mix products with high in a high value industry creates barriers for entry and potentially increases the margins of the company. It has a strategic client relationship where it enters into a 3 to 5 year master service agreement, providing revenue stability and visibility. The customer base of the company spans from India, Europe, North America, China, and Japan, reducing geographic concentration risks. Also, the Q4 performance has been good, with profits and revenue showing strong growth, indicating potential business momentum. On the flip side, what are the weaknesses? Well, there are margin pressures. Recent quarters have shown that EBITDA has been declining despite revenue growth, suggesting challenges in cost management. Working capital also is one of the factors which is creating troubles. Now, increasing working capital days and conversion cycle could strain companies' finances, especially in the day to day operations. The company has paid no dividend, so there is no dividend history, despite consistent profit reporting, which suggests limited income potential for investors. There is a declining order book backlog. Now, the year-on-year decline in the order backlog raises questions about the future revenue generability of the company. The recent acquisition of Altek Electronics has increased cost and might continue to pressure margins during integration phase. Now, investment potential, well, to make a bullish case, the strong quarter 4 results with a 36% year on year jump in net profit demonstrates the business acceleration after previous quarter margin pressures. The company's long term growth trajectory is also impressive. Analyst consensus suggests 65% of them are bullish on this stock. Strategic initiatives like purchase of Altek and partnership with Deutsche Aircraft could drive future growth opportunities. The company operates in a high value industry with strong growth potential and high barriers for entry. To make a bearish investment case, well, the company has a high PE at 49.8, which leaves little room for error if growth slows. Now, return ratios, return on equity at 8.23 and return on capital employed at 12.3 are modest compared to the valuation premium. Working capital and cash conversion matrix show deterioration, which could impact financial flexibility, especially in day to day operations. The stock has underperformed over the past year with a negative return of approximately minus 28%. Company has no dividend history, making the return entirely dependent on capital appreciation. CYIENT DLM presents a mixed investment case at current valuation levels. The company's impressive quarter 4 performance are encouraging and suggest potential business acceleration. The long term growth trajectory remains strong. The fact that approximately 65% of the analysts have a positive outlook with substantial upside price target gives credibility to the bull case. However, the relatively high PE ratio and deteriorating working capital matrix presents valid concerns which cannot be looked away from. The lack of dividend history means investors are entirely dependent on capital appreciation for returns. For growth oriented investors with long term horizon and higher risk tolerance, CYIENT DLM could represent a attractive opportunity at current levels, especially if the company sustains the improved profitability it demonstrated in the quarter 4 results. More conservative investors might prefer to wait for a more attractive entry point or evidence the sustained margin improvements and better working capital management. Given the company's strong positioning in high value industries, strategic client relationships, and global presence, CYIENT DLM appears fundamentally positioned for a continued growth. Though near term volatility should be expected as the company manages acquisition integration and navigates margin pressures. So, this was about CYIENT DLM. What do you think about this stock? This small cap stock, does it have the potential to give multi-bagger returns in the coming years? What are your views on it? Please write in the comment section. I would like to hear from you about this particular stock. If you have liked the video and the analysis that we presented, please like, subscribe, and share to my channel for more such informative content. Always remember, this video is for educational purposes and not a stock recommendation. It is always advisable that you approach your investment advisor to get the correct direction where your investments must flow. Until next time, stay safe and goodbye.